Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, also known as Mr. Valuation. Today's video, I'm going to take a look at electric utility in the New England area, Eversource Energy, and I'm going to talk about this investment from the perspective of an income vehicle, a company that's really increased and grown its dividend by over 7% a year, very consistently year after year. It currently has offering an attractive current yield. But one of the things about it, this is a utility because of the quality of this utility that the market has traditionally valued at a very high valuation. But more recently, a lot of it has to do with some actions the company's taken to get into alternative energy segments has temporarily brought the stock down to really attractive levels. So let's go ahead and get into the fast graphs and take a look at Eversource Energy. Now, I'm going to start with a new featured page here called the summary page, because it gives us a quick summary of the company. Now, historically, the first thing I want you to focus on is the fact that their earnings have grown very, very consistently. If I take price off the graph, you can see that their earnings per share have been almost perfect in terms of growing 5.75% rate. All right, so the orange line on this graph is a 15 PE ratio. And as I pointed out, their normal valuation the market has applied has been about 18. So what I like about this, the most consistent line on any fast graph, and just by looking at a fast graph and glancing at it, you can determine this kind of thing. Their dividend has continued to increase. When I put price on the graph, weekly closing stock prices, you can see coming out of the recession of 08, you could have bought them at very attractive valuations, PEs of 11 or 12, because the orange line is a PE of 15. All right, so you can see that it was below the orange line during this period of time. Then starting in about 2012 or 13, like many, many companies, the market started really valuing things at premium valuations without any real change going on in the business. And I'll get into that in more detail. But one of the things that I think is very interesting, one of my favorite phrases is valuation matters, and it matters a lot. And I think you can clearly see fast graphs doesn't dictate valuation, it reveals it. This is a tool to think with, and it can help you really understand what you're looking at. Once Eversource's valuation is coming into COVID, got into the mid-20 and even high 20s, 5 to 30 PE ratios, you can see that the stock really went sideways for several years. Even though it sunk in COVID, it rallied back, but it went sideways. This is really the weight of overvaluation taking a toll on the company that continued to generate earnings growth. But I also want you to notice, starting in 2023, the stock can be bought for the first time since coming out of the Great Recession at a very attractive valuation. All right, now look, continuing with the summary, the company's future growth rate is expected to be 5.59%. That's consistent with their 5.71%. So in other words, it's the same number as far as I'm concerned, plus or minus a little bit. Again, the fair value PE ratio would be 15 times earnings, and if it traded at that PE, then you would stand to make an estimated just under 13% annualized rate of return as a combination of dividend income, capital appreciation, and the PE ratio expanding from the current 14 level that it's at right now up to a 15 PE. All right, now their analyst scorecard is perfect for the 1 year forward and the 2 year forward. They have literally hit estimates 100% of the time. And that's part of the consistency of this really high quality company. Now, Eversource engages in a generation of transmission and distribution of natural gas and electricity. It operates through electric distribution, electric transmission, natural gas, water distribution, and others. Now, this is in New Hampshire and New England area, and it's obviously a very good utility. Now, there's also some summary information about other of their financial statements, their income statement, their balance sheet, their cash flow statement, etc., on the summary page. But let's go into the historical chart itself, and let's start with it, and let's look at what's really happened with this company. Again, you can see since at least 2006, this company's been a consistent performer. And once again, you can see that when valuation really got crazy, the earnings growth rates were not changing here. This is so important. Nothing's really changing with the company. The dividend was growing during this time. The growth rates were 5 and 6%, which is historically within their normal range. I'm showing on this time frame that I'm drawing here, the average growth was 6%. And again, we're forecasting growth to be about 5.59 or 6-ish%. So it's more of the same, and the stock is slightly undervalued at this point, offers a 4.59% dividend yield. It's an investment grade company, BBB plus, and it has 59.3% debt to equity. Okay, the 14.9 PE gives it an earnings yield of over 7%. And I think earnings yield is so critically important because the average return to stocks over 200 years is like 6 to 8%. A utility like this offering you a 4.5% dividend growing by 6 or 7% a year is really attractive in today's interest rate environment because this offers not only a good dividend income growth that can supplement your income, especially if you're a retired investor, but it also gives you an opportunity for some capital appreciation along the way. And it does it in a very high quality company that, again, has very predictable and reliable forecast ability as far as the analysts are concerned. I'll talk a little bit more about that here in a moment. Okay, but let's look at some other important metrics when you're looking at a dividend-paying stock. Okay, these are adjusted operating earnings. Now, you can also look at diluted earnings, which includes a lot of accounting convention, and this is where you get non-cash charges and one-time events. And notice in 23, we had this huge write-off here, and this has affected their net income and everything else. But if I'm looking at it from a pure cash flow point of view, the company has operating cash flow. I'm not really too interested in stock price when I look at this chart. What I want to see is the orange line, the operating cash flow. For example, in 2009, they generated $5.73 of operating cash flow, covering a 95-cent dividend. Okay, I want to see this orange line above this dividend line. But once again, I want you to note that the company has a modest payout ratio in the 30 and 40% range. Okay, so there's room for the payout ratio to increase, really, from a standpoint of cash flow. Now, this is operating cash flow. But the point is the cash flows cover it. Now, I like to call the asset test when I look at free cash flow to equity on things, but utility stocks are rarely going to have free cash flow to equity that's very stable. And there's very simple reasons for that. One thing is that these companies are capital intensive. Okay, so we can go into the financial statement in FastGraph and look at the income statement, and we can very quickly see that the company has pretty good control of their costs, but their costs continue to rise. Okay, so that's one thing you need to take into consideration. But going into their cash flow statement, we also see the CapEx line, the capital expenditures of a company like this, a utility stock, typically is very, very high. And it's really gone up in recent years, as you can see. And the primary reason for that is they're actually moving into alternative energy sources and really trying to position their company to become carbon neutral and growth. Whether that's a good idea or not is for you to decide. But the point is, this is a really good company. Now, returns on equity, returns on assets, and returns on capital have turned negative in 2023, but they're beginning to turn positive again because of some of these capital expenditures. Okay, so you want to take that in consideration. I showed you that when I showed you the GAAP earnings earlier. All right, but this is a very solid company and it's very stable. Now, let's look at performance because I think that's really important here. If we look at the company from a standpoint of comparing it to the marketplace, the growth component has been slightly less than the overall market, but the dividend component has been almost triple, more than 2 times what the S&P 500 was, and that's what this is all about. So if you invested in 2005 and invested $10,000 into the stock, which is the key point here, in 2005 your yield on cost would have been about 3.5%. Now, currently, I want to remind you that your dividend yield, if you look at going back to the historical chart, the dividend yield is currently 4.59%, your current yield. All right, so you've got a yield advantage there, but look what happened to, we'll call it the 4.5% dividend yield. As time gone on, that yield had ballooned all the way up to over 18% in more recent times, and the average dividend has grown by 7.96% on average, compound growth of 7.9%, and that is faster than the S&P 500. So the key point I want to make here is this is an income vehicle. Okay, and you invest in this stock or a utility stock, typically for the income. Now, most utility stocks grow at 3 or 4%. This one has consistently grown at 5 or 6%, and it's forecast to continue growing between 5 and 6% going forward. But here's one of the kickers I wanted to mention. As I showed you in the beginning of this video, this represents about a 12.71% opportunity if this stock grows at the 5 or 6%. This is a calculator. And by the way, it's critically important if you make an investment that you have a very clear idea of what you think that investment can offer. And by buying it at fair value, you participate in the growth of the business. When you buy it below fair value, you get the kicker of some PE expansion added in. So here you got a 5.5% growth rate, you got a 4.5% dividend, so we'll call that a 10% combined growth and dividend opportunity, but then you get the PE increasing from 14 or a little over 1409 to a 15 PE, and that gives you a 12.71% return. But let's go back and review history for a moment. If you look at this company from the pricing point of view, coming out of the recession, a lot of stocks traded at lower valuations than they historically have. That was just the nature of the recession kind of cleansing the market, if you will. But then since 2013, as I mentioned, we had this premium valuation. But now we've got this opportunity because of some of the capital expenditures they've made, increases have given a little bit of, we'll say, struggle with their net income. The stock is now all of a sudden trading at one of the lowest valuations ever. If you go and look at the current valuation line that we've added, where I draw a line through this last point on the graph. So I'm going to take the current valuation line and draw a line. I want you to note here very carefully that coming out of the recession, you could buy the stock at or below its current valuation for a couple of years. But most of all these years, the stock traded above its current valuation. And then for the last couple of years here, it gives you an opportunity to buy Eversource Energy at very reasonable valuations. So if we go back to the forecasting graph and we look at the normal multiple for the company, not the 15 fair value that a company growing at 6% should command, if we look at the premium multiple that the market has applied, instead of 12.7%, we could make more than double that, or over 26% a year, turning $10,000 into almost $26,000 in just a very short period of time. So that's the allure of Eversource Energy. It's a very solid and very high quality utility stock. It has very reliable energy. It does have some negatives of a lot of their customers complain about high costs and everything, but it is moving into renewables and it is trying to position itself for growth. By the way, I want to make this clear. It was overvalued. From when the stock got overvalued like this, it's really been a very poor investment, even going to fair value. It's simply because it was overvalued. The business continued to grow almost like clockwork at 6% a year. But now you can buy it at a very attractive valuation that is very rare an opportunity. And so your rate of return potential here is what I just already showed you. It can be 12 to 25% a year annualized over the next 4 or 5 years, especially if it begins to command a premium valuation again. But that's unknown. We don't really know if that's going to happen or not. But I really like this company for the income investor. It's the 4.6% dividend yield. And as I mentioned, that dividend has been growing by 8% a year since 2008. Again, faster than the S&P. I can run this out to the max for the whole 20-year period I have here. It's been averaging about, again, 8% a year, more or less. So we've got an opportunity here to see a nice investment, relatively safe, at a very low valuation with a very consistent operating history and expectations for continued performance as it has in the past going forward. Now, I do want to note when I look at the forecasting graph, analysts have ever so slightly been reducing their estimate over the last 6 months, but only very slightly. So all in all, I think this stock is attractively valued. If your income is your goal, I think it's one that you should consider taking a closer look at. Anyway, it's been Chuck Carnevale, co-founder of FastGraphs, bringing you this income idea. And along with Enterprise Product Partners, I'm going to do 1 or 2 more income ideas here coming up in the next couple of videos I do. And by the way, subscribers have asked me to go in to look at some companies that were undervalued, that produced good income, but I had a couple subscribers also ask to look at some total return. So we'll be going to total return investments as well. But even a stock like Eversource really fits both bills. It's got the income component, but it also has the total return potential. And it's certainly a very high quality, very stable, company with an excellent forecasting analyst scorecard. So I'd take a closer look. If you like the video, give me a like, ring the bell so you get to see more videos like this. Subscribe to our channel, and please take a look at investing in fast graphs. It's the value investor's best friend. It's a great tool to think with. It can really keep you grounded and help you make better long-term investment decisions, especially in common stocks. Thanks for watching.